Well, I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim New Year's Special. It's a look back at what happened in 2018 and a look forward to what might happen in 2019. Well, after 2017, which was a very strong low volatility year, 2018, well, that changed as volatility actually picked up for the market very early on. Then again, it went into a slow rise for the year into fourth quarter when something very significantly changed. October, November, volatility in the stock market spiked. And then in December, we saw the worst decline since the Depression for a month of December. And then some wild days as the market actually had a 1,000-point up move in the Dow in a single day, which was the largest point up move ever seen. And then the day after that, it sank some 700 points and then rallied to finish up on the day. Just an example of how volatility has really changed as we've come into the final portion here of 2018. 2018 actually had 15 days where the S&P 500 had changes of 3% or more. That's in contrast to 2017, which had none. So you really get a picture of those changes. Early in the year, well, there was, Fed tightening, and that was taken as a good sign, as President Trump's tax cuts had really helped earnings, and there was some strength showing in the economy, not overwhelming, but at least some steady growth, and the Fed was taking on the chore of normalizing as it was moving interest rates up at quite a slow pace, actually, in little quarter-point upticks. Late in the year, things started to look differently, however, as the high-yield bonds really started to move to the downside. And as interest rates started to tick up, and those companies that borrow at those high rates and are really overwhelmingly in the Russell index, well, those started to really get hurt, and the Russell index really started to move down. The Russell index was the worst performer of the whole year. We will speak more to that in just a little bit. So this change in these high-yield bonds really was, signaling and leading stocks to the downside. Now it appears that a 2.5% Fed fund rate is crippling to the market, which is an outstanding, important point when we talk about market conditions, which now appear to be very fragile. If only that level of interest rates can cause the difficulties that we've seen, we know the kind of trouble that really could be out there. Of course, add to that the fact that we have had record high margin debt significantly, and the record net negative credit balances in brokerage accounts. It essentially says that there was no fuel left for stocks to be moving upward, and actually as stocks move down and there's no cash in brokerage accounts, that brings on forced selling, and we saw the kind of selling that could come into the market. This is a situation that is created by the Federal Reserve. I've been, over the years, extremely critical of the Fed, and that is not going to stop, as they are responsible for these cycles of boom and bust. And we can see that it takes more and more stimulus, as we had 8 years of negative interest, of 0% interest rates, and some countries at negative interest rates, in order to get stimulus in our economy and world economies. You can see that it takes a tremendous amount of stimulus, and it only lifts really the financial assets, as we get all of that financial engineering going on. As companies don't expand their growth, they simply take the money and buy back their stocks, which of course lowers the floats and makes earnings look even better. So all of that financial engineering was the result of the Fed's overstimulating the market and causing another asset boom, while really not helping mainstream at all. You can blame the presidents, you can blame Clinton and Bush and Obama and Trump, all of them, for overseeing a Fed that actually does this and not willing to do what needs to be done to change that. This situation that we have, it's setting up the potential for another period of 0% interest rates, or even NERP and negative interest rate policy in sometime maybe 2019, I think more likely 2020, as things continue to get worse. I'm getting ahead of myself here because we're going to be doing predictions later on, but at most I see one more rate increase in 2019, if that, and we could actually see rate cuts. And I wouldn't be surprised to see a pause in QT in the quantitative tightening, where the Fed decides maybe it's not the best time to be reducing its balance sheet. Reducing a balance sheet takes money out of the economy, just as adding to the balance sheet put money in the economy. If you don't believe it's tightening, well, you could see the response to the markets now, as we've reached a level that is, barely interest rates as related to inflation very high at all. So that's a very important thing to look at. And then, of course, we've got other issues going on, as our president is a protectionist, and he is not a conservative at all, and doesn't believe in free markets. And you could see the way he's acting as he brought us into a trade war in a world that is very fragile. China growth slowing already, and now even slowing more. The Eurozone barely able to get any economic growth whatsoever, and really worldwide showing signs of being a slowing everywhere. Earnings guidance now weakening, and the tax policies had really helped corporate earnings very much, like boosting it over 22%. But now, as we start to look towards the next year or two, when that policy is going to have less effect, certainly on the comparison side, we're going to see issues that guidance will continue to weaken, as we've seen happening now in this last quarter. And of course, investors don't like that at all. And then we've got budgetary issues. As we see right now, the fight going on, build the wall, and if not, I'm going to keep the government closed. And then we have another fight coming up with the debt ceiling. So it's budget and debt ceiling, and it's all about the massive spending and huge deficits and the debt bomb, and what we are building as a horrible situation for our children and grandchildren. Yes, you could see my libertarian sign there behind me with the dinosaurs, who are our present leaders, holding up that sign, which is maybe the only real political comments that I make about myself, which is, I certainly believe in smaller government and non-aggression policy, and the fact that we need to have a balanced budget to get through all of the difficulties that I believe we are in, and continuing to look forward. And the move in the stock market from 2009 up till this year, 2018, has been based on this Fed manipulation. So I think that there is trouble out there, and what I really want you to do is to go read my special report. You have to be a level 1 member. It's free, and that'll give you my thoughts about the markets going forward, and some more detail about what I've just discussed. And later in the show, I'm going to give you my projections for the coming year, and of course do a review of the stocks that I picked for last year in the markets, and also review the picks for the coming year and the individual markets, what I think is going to happen. So you want to make sure that you watch that part of the show coming up. With just a day to go now, as I'm recording this on Friday, the 28th, we still have the last day of the year on Monday, the S&P 500 making a big recovery along with the Dow. They're down about 6.7% and 6% respectively. The NASDAQ only down a couple percent here for the year, but the Russell, the big loser, as I said, is those companies that are predominantly losing companies, really face these interest rates going up, and the Russell loses 13% on the year. Bond market, choppy year, as we had the 10-year have a low of 2.42%, and then go all the way up to 3.24%, and now closing the year out about at 2.75%. So interest rates moving up, the 10-year notes moving down about 3 points on the year. Pretty volatile year for interest rates, and probably the next year will not be as volatile for interest rates based on what I just said. The dollar moves up about 5% on the year, certainly benefiting from a safety bid. Issues out in the Eurozone, keeping the euro weak, and looking like it's going to get a lot weaker. That is support for the dollar moving forward. I will discuss that also further as we get into the show. The gold market losing about $30 on the year. It was down $130 on the year, and then coming back, we had done a special report on gold back a couple of months ago where we saw a $100 move to the upside coming, and there it was. So you're going to want to get our projection for that moving forward also. It was actually losing $30 for the year for gold based on the really strong dollar. It was an overall excellent performance for the gold market. Oil, which was up 25% for the year into October, collapsed, declining 44% in value from its October peak, now down about 25% for the year. So that's the kind of a year that it was. Of course, usually in market week, I give my short-term view for the coming week, which is not going to happen in this show because it's a much bigger picture show. So if you want to see the shorter-term view, make sure you watch our Future Speak show, which is always on Wednesdays for level 2, 3, and 4 members. So coming up is our projections and review for last year and for the coming year. Market predictions for 2019. Make sure you follow me on Twitter at askSlim, subscribe to me on our YouTube channel, and go to askSlim.com and check out all of our memberships where you will be able to see free membership and all kinds of things in there that I think are very valuable to traders and also to investors. So every year I say the same thing. Crazy it is for me to be predicting out a year in advance. Looking at what could happen in a full year we already saw this year, Well, a tremendous amount can happen. As you can see, many tone changes, many changes of market conditions, and some awfully big swings. So I tend to like to more focus on range, predictions of ranges for the markets than I like to predict about, something like where I think they're going to close. I think I'll give some closing ranges in here for the coming year, but really it's more, I'm more interested in getting the ranges and timing, because price and time is really what cycle analysis is about, which is of course the core of the work that we do. With the present political environment that we have here, there's huge volatility expected. We're really, we're going to hear a real war going on between the left and the right in this country. When the Democrats take over, we're going to hear a lot about impeachment. It's going to be a common word, and there is going to be fights, and that is going to be in the background news. Of course, we have the fights over the budget and the wall, and over the debt ceiling coming up, and then we can see that the president is of the mind to burn it down rather than to come up with any kind of real long-term solution, or maybe that is his long-term solution. So we expect some continued volatility in the markets. I always do want to be accountable to what I said in the previous year, so we're going to look back at the stocks for 2018, and I got to tell you that my predictions for the year for the stocks, the riskiest and the best stocks for the year, were my worst ever. I can't remember a time when I was so far off on the stocks that I really liked. Usually I get that right, and I'll show you where I really went wrong. The markets, I was really good. In fact, a bullseye almost on the stock market, and I'll show you that. And Bitcoin was a phenomenal call. So there were a lot of good things about the market calls that I had. And I think we're going to see my stock picking improve this year. I always work hard to, when I do my analysis at the end of the year, going through over 300 stocks, what I look at is valuations and scenarios. And sometimes when I get the scenarios wrong, the valuations don't really matter. But I'm still going to look at that and see, and you'll see that when I tell you about the stocks that I like and dislike, that part of that analysis is going to be there. When I get to my predictions for the markets for the next year, for the first time I'm going to actually show my charts and give you an idea of how I came, based on the cycle analysis, to the predictions that I have here, looking out long term for the market. So I think you're going to find that aspect of it really very interesting. So we're going to go to the first slide in here, where we're going to look at my riskiest stocks that I talked about for 2018. And this one was not great, not horrible, but the long side, the stocks that I loved were really bad. So here we'll take a look here at this first slide. The first slide we're going to look at in here is the riskiest stocks for 2018, and you can see in here that 8 of them were up, 6 were down, 1 is unchanged. You just watched the opening to the askSlim Market Week show. To watch the complete show, just become an askSlim Level 1 member. It's still no cost to you. It includes my analysis on the best and worst stocks for the week and my projections for the short-term view of the coming week. There's always a chance to learn a lot about special situations, cycle analysis, all kinds of technical analysis, and of course, potential trading opportunities. We have an unbelievable offer here in that you not only get the full askSlim Market Week show, but you get the Market Week archives, which were not available to you unless you were a member before. Plus, you will get special Level 1 videos that we put in there from our premium library, and sneak peeks to new product launches, and of course, more specials along the way. Become an askSlim.com Level 1 member, no cost to you.
I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been